Today we would like to talk about the foreign market equilibrium. So yesterday we talked about the money market equilibrium, which reflects the relationship between the interest rate and the money market, the money demand and money supply. So today we would like to take a look at how interest rate is correlated with the exchange rate. So firstly, we would like to just clear out the playground, right? So when we talk about foreign exchange rate, there are actually two types of exchange rate. So there's the spot exchange rate, so which is basically that you agree to get the exchange between two currencies at the spot today. And then there's another one, which is the forward exchange rate, which would happen sometime in the future that you agree today. And then so these are the two types of exchange rates. And then for exchange rates, basically it reflects the price for a currency. So you can look at currency as also a good, right? As something that can be tradable. So for all these things that can be tradable, there's a price for it. So there's a price tag for that, which is the exchange rate. And then usually, just to standardize that, we usually write it as exchange rate. And then, so basically, it's the amount of home currency you would pay as price to exchange 1 unit of foreign currency. So for example, in terms of Canadian dollars and US dollars, let's say that it's 1.37 now. So which means that you are willing to pay $1.37 of Canadian dollars as the price to in exchange for $1, right? Okay, so therefore, also just clear up the assumption that because this is exchange rate is the price for a good, which is a foreign currency, then whenever it would also satisfy that demand and supply curve, right? So we all know that the demand for a good usually is downward slope, and then the supply is upward slope. So therefore, whenever the demand increases, the price also increases, right? So therefore, whenever the demand for a foreign currency increases, then the price, which is the exchange rate, the amount of home dollars to in exchange for that foreign currency would also go up, right? Which means that the home currency is actually depreciating because the demand for the foreign currency increases. Okay, so once we have cleared out this background, then we can start our foreign exchange rate market equilibrium model. So basically, it's looking at it from the angles of rate of return of your investment, your financial investment, usually in terms of bonds, right? So it's really looking at, this rate of return of your assets, right? Of your financial assets point of view. So, let's say that, you are buying. So therefore, this on this graph, you would have, a rate of return at home, and then you will have a rate of return in foreign asset. Um, so if it's okay, so and then we are gonna also put exchange rate on the horizontal axis, right? And then because if you're really evaluating between these two choices, the the type of variables that would be included are really the interest rate, right? Which is the just the return of the bond. But then there would also be exchange rate involved, right? That's how you would actually compare the rate of return between these two type of investment vehicles, right? So um let's say that if like at home, right, if the interest rate today is fixed, right, and then regardless of the exchange rate, you don't care, right, because you're actually buying the bonds domestically. That's it. So therefore, the rate of return, let's say from a year from now, right? Let's say that the interest rate right now is 3%, right? And then a year from now, then the rate of return then is 1 plus I, the home interest rate, right? So therefore, it's not gonna change corresponding to the exchange rate. But if you rather put your investment in the foreign market, right? Let's say that in the foreign market, the interest rate is IF, right? And then what you would do today is that, so firstly you would like so this is $1, right, of home dollar. So firstly you would exchange it to the foreign currency, right? So then that is basically your home dollar divided by your exchange rate today, right? The spot exchange rate. And then so now this one is actually in the foreign currency, right? You exchange it to foreign currency first, and then you invest it into the bond in the foreign market, which is IF, right? And then you basically needs to times this 1 plus IF, which is the amount of money you would get a year from now. And then from looking at this, we see that if, let's say that if this spot exchange rate increases, which means that your rate of return actually decreases, right? So therefore, the rate of return in this foreign asset is actually a downward slope. So this one is this horizontal line is the rate of return at home, and then this downward slope is actually the rate of return in the foreign asset, which is which is having a negative relationship with the spot exchange rate, right? And let's say that and then we can actually, kind of like, okay, and then so after, after we get this amount of money in foreign asset a year from now, this is not finished yet, right? Because eventually, if you would compare the two different vehicles, right, two different venues, you would still need to bring them into the same currency to really have a fair comparison. So therefore, a year from now, after you get this money from the foreign asset, then you would again exchange it back to the home currency, right? And then for that, you would actually times the currency, the spot currency at that time, which is the expected exchange rate, right? So therefore, after this whole process is completed, then you can have a leveled comparison. So then this rate of foreign asset is really that, you divide it, you convert it into the foreign currency first, right? And then you times then you multiply the interest rate in foreign asset, and then convert it back times this expected currency, right? Convert it back to your home currency. So therefore, to get the foreign exchange market equilibrium, we are really equating the rate of return at home with the rate of return abroad. Because let's say that you are not really at the equilibrium, at the equal point, right? Let's say that you're some point here, right? Okay, let's put maybe like this one, right? Okay, let's okay here, right? Let's say that you are some point here. So some point here, not at the equilibrium. And then at this point, the rate of return at home is higher than the rate of return abroad. So what you can do is you can just, you can just exchange your foreign currency, right, to the home currency, and then invest it at home asset. And then because that rate of return a year from now is higher, and then you only need to repay the foreign currency at this 1 plus interest rate f terms, right? So therefore you actually earn the arbitrage, right? So you actually earn some free money if you do it that way. So therefore a lot of people are gonna do that, which would increase the demand for home currency, right? And then we say that the exchange rate is just a price for a currency. So therefore, when the demand for the home currency increases, then the exchange rate actually decreases because because your home currency actually appreciates, right? So therefore, it just, whenever it's not at this equilibrium, it's just going to go towards it from the right. Same thing, right? Same thing if you're here when your rate of return abroad is higher, then you're just gonna invest in this foreign market, and then that would lead to the demand for the foreign currency to increase. So therefore the exchange rate will increase. So your home currency decreases up to this this equilibrium point. So from here you can really see that the foreign exchange market equilibrium is really to equate the rate of return at home and the rate of return abroad. And this is and this this equilibrium, right? There's a name for it, which is called uncovered interest parity. So that just means that the two returns equal to each other. So which is, we can just kind of write it out, which is this home rate of return equals to the rate of return abroad. Okay, so here, so this one abroad, which is this, right? And then right, so and then after after you kind of rearrange this, so this uncovered just means that your investment is exposed to the risk of exchange rate. So you're really incorporating the exposure to the exchange rate into the equation, into the process. And after rearrange this, this thing, right? This equation, then you can get the equation to for this exchange rate. So for this exchange rate, you can actually get the equation for this exchange rate, which is really just y plus your foreign interest rate divided by your home interest rate, and then times the expected exchange rate. So from this formula, so you can see that whenever your foreign interest rate goes up, then your exchange rate today actually goes up too. So which means that if the foreign interest rate goes up, your home currency will actually depreciate. So this is kind of like it can be intuitive, right? So which means that whenever the foreign interest rate is high, then just to offset this advantage, offset this arbitrage opportunity, you have to depreciate your currency to offset this gain, right, from the foreign interest rate. So to make it, because it's making it less favorable to exchange your home currency to foreign currency to make that gain in that foreign interest rate, because you're just offsetting that gain, right, in the foreign interest rate. So to make the investment parity actually work, right? So this is one rule. So from this equation that you can get is when your foreign interest rate goes up, then your home currency actually depreciates. Another one is if your expected exchange rate goes up, which means that if you expect your home currency would depreciate later, then it's gonna start depreciate today. Okay, so when expected depreciation given, then your today currency will depreciate. So this intuition is actually kind of funny that we would take some extra time to explain tomorrow. Hope that's clear.